Benjamin Franklin once said that in this world, nothing is certain except death and taxes. Such prophetic words. We cannot escape taxes just as much as we cannot escape death itself. But what if I tell you this wasn't exactly true? Hey, what's up y'all? It's Shawn, your Charleston realtor. Did you know that there is ways you can defer or entirely prevent taxable events when real estate is involved? In this video, I'm going to explain how capital gains tax works for primary homeowners here in the United States. Now first, I have to add a disclaimer that I'm not an accountant nor an attorney, so be sure you consult with your tax professional for your particular situation. In no way should this video be construed as tax advice. I am merely sharing my own experience. So let's get to it. So what are capital gains? Well, the term capital gains refers to the increase in the value of the capital asset when it is sold. So put simply, a capital gain occurs when you sell an asset for more than you originally paid for it. For instance, let's say you bought a house for $300,000 and sell it for $500,000. For simplicity's sake, let's say you didn't have any fees associated with the purchasing or selling the home. Your total capital gain from that event would be around $200,000. Now, capital gains should not be confused with ordinary income. Ordinary income tax applies to income earned from regular activities such as wages, salaries, and commissions. So think the paycheck you get from your job. This graphic right here breaks down the 2023 ordinary income tax rates, while this graphic breaks down the 2023 capital gains tax rates. As you can see, ordinary income tax is typically higher than capital gains tax. There are two types of capital gains, long-term and short-term. A short-term capital gain refers to an asset you buy and hold for less than a year, whereas a long-term capital gain is an asset you buy and hold for greater than a year, though there are some nuances there. Typically, a long-term capital gain is taxed at a lower rate than ordinary income, while short-term capital gain is taxed at the same ordinary income tax rate. So now that we've broken down just what capital gains are, let's discuss how it applies to real estate as a homeowner of a primary residence. I'll touch on investment real estate in separate videos. So as a primary homeowner, you get probably the best aspect of the tax code possible. That is, you may qualify for a massive capital gains exclusion, commonly referred to as a Section 121 exclusion. Most of the information can be found in the Internal Revenue Service publication 523. This code exists to help homeowners grow wealth in the long term by sheltering capital gains from the sale of their primary home, which encourages moving and upward mobility. As a homeowner, you're entitled to $250,000 in capital gains exclusion as a single filer or $500,000 as a joint filer, as long as you meet a series of eligibility tests. So if you bought a home for $300,000 and you sold it for $500,000, you're not actually taxed on that $200,000 in gains as long as you qualify. That's a huge savings. Anywhere from $30,000 to $50,000 remains in your pocket and doesn't go to Uncle Sam. But let's talk about the eligibility requirements straight from IRS publication 523. First, you're disqualified from the Section 121 exclusion if you acquire the property through a 1031 exchange or if you're a foreign citizen. Now, if you don't know what a 1031 exchange is, then you're acquiring the property through it definitely doesn't apply to you, so don't worry about it. Second, you need to have both owned the property and lived in the property for 2 of the past 5 years. There's also a look-back period, which says that you may take the exclusion only once during a 2-year period. And lastly, there are multiple exceptions to this eligibility test, from divorce to death to destruction of the property. I'll leave a link in the description to the actual IRS publication, but one key exception I want to go over is actually for service members. The IRS says that members of the military may suspend this 5-year eligibility test for a total of 10 years, as long as you're on active duty and serving at a duty station at least 50 miles from your main home. Technically, this means that instead of being eligible for the capital gains exclusion for 5 years, you can bump this out to 15 years. So definitely talk to your CPA before you try to claim this exclusion. But wait, what happens when you move out of your home before that 2-year mark? Well, the IRS also allows for a partial exclusion. If you move because of a work-related move or a health-related move, unforeseeable events, or due to other facts and circumstances, you can still claim a part of this exclusion, and typically it'll give you the same advantages. What you do in that case is you take the number of months you lived in the home, divide that number by 24, and then multiply the resultant decimal by the $250,000 or $500,000 exclusion, whatever applies to you. For instance, let's say you bought a home for $300,000 and then you had to move far away from that location due to work a year later. In that case, you would take the 12 months that you lived there and divide that by 24 months. Multiply that decimal by 250,000. Now we know that 12 divided by 24 is 0.5. So in this case, you're excluded up to $125,000 in capital gains. So if you somehow manage to sell your $300,000 home for $425,000, well, first, good on you. Second, probably not gonna happen. That meant your home would have increased in value 30% in 1 year, which is entirely unrealistic. But even then, in this situation, you'd still be protected from having to pay any capital gains tax. Now, up until this point, we've talked about capital gains in a very basic sense. You buy a house for 200, you sell it for 800, and bam, you created $600,000 in capital gains. This isn't exactly true though. You do incur expenses in both the buying and the selling of the home. For instance, it probably costs you money to acquire the mortgage and the interest rate to begin with. And when you sell the home, you have expenses such as repairs or realtor commissions. And also, what about if you improve the home? If you add value to the home, such as adding a swimming pool or a bedroom addition or some other major capital expenditure, you can actually add that cost back to the basis of the property. So let's say you bought a home for $200,000, but then did $100,000 worth of allowable upgrades and improvements, then your total cost basis would be $300,000. Not the $200,000 you paid for it. Sell it for $800,000 and subtract that 6% realtor commission and then some other repairs, then all of a sudden you're well under that $500,000 threshold if you're a joint filer. So at the end of the day, the key thing to remember about the primary residence capital gains exclusion is that you have to meet a couple of tests, most notably owning and living in the property 2 of the past 5 years, though as we discussed, there's a ton of exceptions to this. Also, remember that a capital gain is just the difference between the cost basis, which might change depending on the upgrades and upfront expenses, and the sales price, subtracting your selling expenses. I hope this video provides clarity to all of you homeowners and homeowners to be, and I'll see you in the next video.